inflation at a time when it's not really a threat here right now. What do you think about that?
No, I think it's exactly true, and I didn't have time to explain it, but if I would have said exactly that. You know, the price of bonds, long-term bonds, is inversely proportional to the interest rate, and so and of course, when you have higher expected inflation, the long-term interest rates go up and bond prices fall. So you have a fundamental conflict of interest, and of course you can see this in the business press when you see when the unemployment figures come out, when they come out really good, the unemployment rate falls, the price of bonds, the bond markets fall. And so they have an interest that's antagonistic to the majority. And that's why, you know, it was that cartoon was actually accurate in terms of the view and actually the mandate of the European Central Bank, which is worse than the mandate of the Federal Reserve, which is supposed to care also about employment. And sometimes they do, in Bernanke's case, not so much in Greenspan's case or the previous chair. You have a conflict of interest, and so you don't want the financial sector to be the people who determine monetary or fiscal policy in your economy. And so that, you know, leads to, of course, the answer to the question that you raise is why is this? And part of that answer is the power of Wall Street in this country. In other words, that's the most powerful interest group, perhaps, in the determination of economic policy here in the United States. And so you're going to get there. That's one of the reasons you have this problem. And you know, it was interesting in the cartoon. You might remember they brought out the old woman who said how, you know, we're the ones who lose from inflation because of our pensions. And it is true, if you have an absolutely fixed income and there's inflation, then you will lose in terms of real income. But in the United States, we do have Social Security is indexed to the consumer price index. There are some politicians who want to cut that, but so far they haven't gotten away with it. And so it's not necessarily pensioners that lose in this country. And in fact, you know, it cuts both ways for people living on retirement. I can, you know, if you can remember the early 80s and the late 70s when interest rates were, when inflation was very high, you had double-digit interest rates, and you had a lot of retired people living off of certificates of deposits that paid 11, 12, 13, even more %. So again, we don't want interest rates like that. But the point is that their simple statement that it's always the poor who lose and pensioners who lose from when there's higher inflation is really not true. And I think the class conflict that you identified between the bondholders and everyone else is the much bigger one, because for the vast majority of people it's really employment that matters. And you know, most of us in this room, almost anybody here in this room, would be willing to trade off, you know, take another half point or 2 points of inflation to get a couple million more jobs, if that's the trade-off. And it's the bondholders who wouldn't make that trade-off.
We're going to take one more quick one, and then we got to get Mark over to his Al Jazeera interview.
You and Dean Baker did good work on the federal Social Security system. Most of us in this room are on a public pension here and are not in that system. And we're bombarded, you know, ongoing basis with people of Civic Federation talking about the unsustainability of the public pensions here. I can't expect you to comment in detail on our situation, but can you send some of your staffers out here to generate some papers and opinion pieces, because the general public, and they're told over and over again, there's an $80 billion hole in the state budget is $30 billion, therefore we have to throw everybody overboard. and we really need some help.
Yeah, okay, you know, actually, Dean did publish a paper very recently, it's on our website, dealing with exactly that issue, and he shows that the public pension crisis is grossly exaggerated. And I won't have time to explain it right now, but you know, one of the major points of the paper is that if you're calculating the return on the stocks that these pension funds hold, going forward, it's very much the opposite situation as it was back in 1999 or 2000, when you had a big stock market bubble and you had price-to-earnings ratios of over 30 to 1. There, you couldn't calculate a higher return. You couldn't calculate a 7 or 8% return going forward, because those stocks were going to drop. And now you don't have that at all. In fact, you have stocks somewhat undervalued. So if you're looking long term, these pensions are much more solvent than a lot of people are portraying them. So yeah, we can. I don't know if we can send. We could possibly. We'll talk about whether we could send somebody out here for it.